for us, from a data analytics side, we have three really distinct businesses with different products and different needs. So it really ends up being a different approach at each of the businesses. So in some instances, it's very narrow and tactical. So at a line of business or subsegment of business, and it's focused on underwriting or claims or even triaging operational issues and moving things through the deciding what to move through the underwriting process faster. In other places though, it's, I'd say, much more strategic, and it's giving us views in terms of market trends or insured behaviors that then inform your strategy. So, I think it's you need to be agile and be able to understand what the data can and can't tell you, and pivot and use it appropriately.
We commissioned a survey last year, and 67% of respondents said, from an underwriting decision-making perspective, they don't have all the necessary data, right? And 43% suggested that they're making decisions without all of the necessary information. So to you, Janice, how do you feel from a confidence level perspective? Does the company have all of the necessary data? And again, obviously it can be a case-by-case basis, right? But, where do you see it's really good, and where do you see maybe that it might not, or maybe you don't have all the necessary data?
So that's the quest, right, for better data. And, at the core, right, data is about helping you understand your exposure. So, by the nature of the products, those lines of business that are kind of closer to the customer, you often have better data than maybe on the reinsurance side, and you're even a step farther away on the retrocessional side. But I think for us, to the extent our clients can provide us better data, because a lot of times, particularly on the reinsurance side, right, it's about the clients providing you the data. That helps us understand their exposures, and we can give them credit for that in our underwriting process. And that then we can make, maybe have more confidence, offer more limits, just kind of have a better feel for the underlying risk. But I will say, this greater ability to measure things better, you also can't forget about parameter risk, right? Just because I think you can become overconfident, like you can have, like you said at the beginning, there's so much data, and models are getting better. It's so, when I first started, I did back in the DFA days, for those of you who remember that, you'd run 2,000 scenarios over 24 hours and then, see what you get. Now you can do that in about 12 seconds. No, I'm not kidding. You really can. So but you can't forget about parameter risk, and that can really magnify negative outcomes. So there's you just still have to be practical and realistic in terms of your evaluations of risk.
Matt, in your opinion, is there an over-reliance on data analytics, or have we found a balance, if you wish? And if we haven't, where do you see that balance from your perspective?
I think it's certainly part of the process. It's more of a comparative tool rather than an absolute tool. We've always taken a sort of three-step process, like qualitative first. So the underwriters with all their experience are the first people to go through the information, understand the risk. They know the people, they know the underwriters at the insurers, and obviously we're protecting them. We then go on to our quantitative analysis. So we look at the data that we get in, the exposure data sets. Part of that process, as Janice said, is being comfortable with that data and actually being confident that it's the right inputs. So it's important, and one thing that we do is we score the data sets as well to make sure that we obviously have the level of detail and it's the right quality. Because obviously if you don't have the right quality used in your models, then obviously you need to be aware of that on the outputs. And then our third step is kind of how does that fit in our portfolio? And it's similar to what sort of Nick was saying and what we do. We look at it on a marginal basis on the portfolio. We compare risks on that basis. So if I only have capacity to write a certain number of risks, we compare them on a portfolio basis in this third step. And part of that for us is we look on a statistical basis in terms of stochastic view, but we also look on a historical view as well. So we look at historic events as they apply in today to see the impact on the portfolio going back, in our case, around to about 1900 from the events that we've catalogued. That then gives a sort of a direct comparison, particularly for our own investors, to say, okay, this is the last 100 years. We know it's not complete. That's why we do a full 100,000 year or so stochastic view. But these are the actual events, and these are the ones that impact the portfolio. And I think that's actually quite important to actually give examples of potential exposures that can happen. For example, Texas City explosion is comparable to Tianjin or Beirut, for example, on our marine book. So therefore, these events do happen if less infrequent. So I think that the three-step is very important. Obviously, the underwriters, in our case, 40 odd years experience or more in Don Kramer's case. So it is a very important tool to use that first. And obviously then the quantitative analysis supplements that and gives you parameters around that. But then you obviously get a better understanding of the parameter risk because you've had the underwriter's view.
Is that computer modeling? Is that data analytics that is comparing these events for you? Or is that coming from the personal experience side that says, well, wait, this seems pretty similar to this one, and so then you match them up? How does that come about for you? And does that question make sense?
Yeah, no, that absolutely makes sense. I mean, that depends on the line of business. Something like our marine energy retrocession book that we do at the fund. Obviously, we have our proprietary model that we've built for that. But obviously, the historical events, we've got to then translate those into comparable events now, today. So that obviously is a bit more kind of a bit more subjective, a bit more involved with the underwriter. You compare that to perhaps historical cat events where we have the exposures using our software tools, where we've actually got the storm tracks. We can actually look at the wind fields. We can even adjust those wind fields if we so wish. That means then that's a bit more analytical than perhaps the marine energy, which is a little bit more subjective to get the exact same risk.
So in your mind, Connor, in your current experience, are you seeing this at all? Are you seeing a pressure to turn around information faster? And do you find that to be a major issue within your company and within the industry in general?
So I think that's been a facet of the industry for for as long as I've been in the industry, to be honest with you. Which is not quite as long as Janice, but I suspect I may do her on seniority in terms of years. So I'll get that out there. So I started in the mid-90s, and definitely there's a big push to turn around analyses quicker than was the case. Partly that's driven by the fact that the kind of computational advantages we have today, again, as Janice was referring to, what used to take us a very long time back in the 90s can be the kind of, a click of the fingers these days. And I think, so that's understandable. But the qualitative aspect of the underwriting process is not necessarily that different. So, again, Janice and Matt both talked about that qualitative aspect, and something that we think is extremely important. And having the time for an underwriter to absorb the information that's been passed over and to really run the rule over the various analyses that we as a risk team may put in front of them or that are generated within that underwriting team as well. The time that takes hasn't necessarily changed. So it is slightly unfair to try and turn the underwriting process into something that's purely about cranking a handle, and now you can crank the handle quicker, so you should be able to get your quotes out in half the time. So we do try to be respectful of our underwriters' time, and at times we do have to push back. If we're being asked to do things more quickly than we really feel we can do them properly, we need to push back on them. There's definitely a push for faster turnaround times, though. And that also goes back to the data issue. Some of the things that were being said earlier on about, do we have all the necessary data? Yep. Actually, sometimes having more data isn't necessarily that advantageous. It's really about the quality and reliability of the data you have, and having tools that allow you to deal with it in a quick and effective way is really important to us. So I've been working on some things internally over the last few months. And it is a little bit going back to things that we used to do a lot more of, and maybe we felt that those were now kind of complete and we don't need to worry about them. We're having to kind of reopen the can on and sort of do things around augmenting the data that we get from our clients and from our brokers, using external data sources to help us really qualify that information, help us understand it a little better, and sometimes help us to sort of change those inputs to get to the outputs that we think are more representative. So it's an ongoing challenge to process the amount of data that we have coming in, to present it to our underwriters and allow them to have that qualitative overlay and sort of adjust our view, and then feed that back. So yeah, I think that's a very long-winded answer. I apologize, Tom. But,
no, it's great.
Yeah. So one other, as part of that answer, one point that I want to make about, our general data analytics and technology and some of the things that have changed. I would say as recently as 5 years ago, if you wanted some serious computing power, you're talking about a 7-figure investment in servers, server rooms, staff to support all that infrastructure. And today, with all the cloud services out there, and being able to basically build cloud first, we're able to just say, hey, you know what, for this portfolio run, I need just a massive amount of processors and RAM, and you just log into a portal on your cloud service. You dial up the resources that you need, and you can perform all the analytics you need pretty timely, without ever having to make that big upfront CapEx expense on servers and IT. So I think that's been, especially really within the past couple of years, there's been a lot, especially here, we've gone kind of cloud first from that approach, to really drive the amount of computing resources that we can have for our data and analytics. And that's everything from, building out data transformation pipelines and running, running any kind of analyses we want to do on the data we have, which I think has just made a massive difference, right? There's really not a large barriers to entry on having the IT support that you need to be able to do these types of larger data analytics. But I think we honestly take a similar approach to what Matt described as, we get modeling data, we get stochastic modeling data, and we spend a lot of time looking at historicals and looking at historical events and trying to come up with recast losses for the deals that we do. I think, I think that really is how we try to think about deals on the cat side anyway. And where we've really tried to use data analytics, I mean, if you think of any type of report or analysis you need, there's really, the time that's involved in collecting the data and producing a report. And, everybody, as a software guy, I'm sure, you use the word seamless. Everything is seamless in the tech world. And the reality is that nothing's seamless, and that there's always a lot of, human points along the way where that involve, data entry, data checking, data scrubbing. So we really try to, kind of optimize the ratio of time that we have to spend, generating a report versus the time we spend analyzing a report.
One, from an industry perspective, do you see a push from the industry as an aggregate, right, to create a data standard across the entire, the world, if you wish, to help better provide that seamless, integration amongst all of the various players, from the agent broker market all the way up into the reinsurance, ILS, all of that?
So a couple of thoughts. Some of that's happening just by brute force of the regulators and not necessarily the financial regulators, but on data privacy, for instance. So that's being driven on making sure the parameters of data is, those parameters are uniform across markets, and that information sharing. I mean, the old days where you would take from a cedent any cocktail napkin with a bordereau and pay on it are over. And there have to be some parameters that are there before payments can be made, and how that data is stored and what is stored. But there are two trains of thought, if you will, along having one universal data set that everybody contributes to and everyone uses, is the competitive advantage.
Right.
Yeah.
And we talked a little bit about the buy or build sort of strategy of getting set up. And I think more and more companies are using that approach, particularly the startups, of what can they buy immediately, what can they rent immediately to get started up. But if you think about the established legacy firms, they have quite a bit of investment there. So they're probably less incentivized to have a complete data set that everyone shares.
Do you see the markets continuing down this trend of more regulation, or do you think we're at a good point? Or what's your take on this from the regulatory environment perspective?
So you may know I'm a former insurance commissioner, so I embrace regulation. I embrace it, and I think in many ways it validates what we do from the industry perspective. So I'll give you a great example. Last summer, the Bermuda Monetary Authority teamed up with the Prudential Regulatory Authority out of the UK, the Bank of England, and did a stress test on the Bermuda market and the resilience of that market, and we came out with flying colors. And so that was a validation, if you will, that the market is able to handle, and particularly on risk parameters and aggregation of risk. If you think about what the Bermuda Monetary Authority is doing today on aggregation of cyber risk, particularly when you look at silent and affirmative cyber, really some groundbreaking work that companies are learning from, and it's forcing the industry to look into or face affirmative cyber and price accordingly for it. So there are some very positive attributes coming out of the regulatory world, but we're also seeing more international standard setting, if you will, and trying to harmonize regulation. You know, we're a guest market, if you will. Our companies, our ABIR member companies, do business in 150 countries. So our job is to make sure that our regulatory regime is recognized, and that those regulators in those countries understand the capital basis or whatever the regulatory regime parameters are that they're interested in. And so it's very important that we have that communication, and more importantly, it's important that those markets don't have conflicting regulatory standards, and privacy is a good place to start.
You know, from a global company perspective, right, because you are very global, you know, how does this affect your view of risk, and how do these regulations, do they make it harder for you? Do they make it easier? Are you constantly trying to shift and adjust based upon the regulations? Like, what's your thoughts on it?
Yeah, I think I would start off with a big thank you to John. I mean, ABIR, being a Bermuda company, ABIR, it's just, they help us so much. I probably get 5 or 6 emails a day from somebody over at ABIR giving us a heads up about something that's changing, or something that we should be watching, or maybe it was on our radar already, so it's just confirmatory that we're thinking about the right things. So it really, ABIR is indispensable to us. It's very helpful. I'd say as a global company, we and COVID was like the test, or a good test case for it. It's so helpful when you have regulators that take the time to get to understand your company and your exposures and what you face. And I think the Bermuda regulators, as John said, they're very thoughtful that way, and I really appreciate that. But I would say, like in COVID, for example, with all these regulators all over the world, you're getting different versions of the same data request all at the same time. And when you've got, 30, 40 of them hitting, and you need to, figure out how to respond slightly differently, it's like sometimes you're like, well, isn't there a more efficient way to do but you also have to, kind of step back and say, well, each regulator has their own responsibility, but it's not really that efficient sometimes. And I know the supervisory college process tries to address that to some extent, but I think when, big issues come up, or emergency issues like COVID, or climate change isn't like new, but still there's like a lot of focus on it these days, or cyber, it just sometimes you feel like it could be a little bit more efficient, rather than scrambling to answer the same question 30 different ways.
I think the recognized standards point that John mentioned is a key one. Obviously, the less differences you can have of reporting requirements and what you're required to do in different jurisdictions is obviously easier for us as a firm. I think also on the exposure side for that, it's important to have some flexibility in your system to make sure you can actually report at the granularity that's required in different regions. So that's something that obviously you can't really change overnight if you get caught out by that. So it is something you need to look at further down the line to make sure you're able to IFRS is a probably a very important one there in terms of making sure you're able to report at the granularity of line of business or that level that you need to be able to report for that. So I think that's the key thing, just making sure you keep on top of it. But the recognition between jurisdictions does certainly make it easier.
And Matt, on that side, from a technology perspective, as that's where I am, when you look at that reporting standard and you look at the granularity you need to get to, does that put stress internally on we need to come up with, our own systems to create these reports, or does that incentivize you, or does it make you say, you know what, let's go out and find a vendor, or let's find a solution in the markets today that's going to help us with that so that we don't have to focus on that? Is that something that you guys think about, and how do you go about making that decision?
I think that's on timing. I think a lot of the ones so far are kind of a level which you'd hope you'd be reporting anyway, just for your own internal purposes. Obviously, if something just change overnight, then obviously there's potentially not time or resources internally to get something sorted in time. So it's probably at that point that you're probably more kind of looking outside externally to solve a problem. But as I say, hopefully you're kind of looking at the level of detail that you need to report anyway, because it is very important internally in most cases. That's the reason why they're requesting at that level.
Connor, what's your strategy, from your perspective and at the company level, to transition from, let's say mainframe legacy software into newer technology?
Yeah, so the cloud technologies have really impacted the way that we think about how we resource for compute, right? So Nick's kind of touched on some of that already.
Yep.
It is a transformative technology for the industry. We've been evaluating elements of a couple of cloud platforms for the last couple of years, and when I say evaluating, we're building proof of concept systems. So we're looking at some of the legacy systems that we've built internally using big data centers and lots of proprietary technology, and saying, okay, how do we switch ourselves from that model to this cloud model? One of the things that we've identified is that where we have very modular systems, so where our systems are kind of packages of capability that we have strung together and maybe grouped around a data set, we're much better equipped to make that transition than where we've maybe relied on monolithic systems. So where we've put together something that's really very integrated, where you have kind of technology choreography and business logic and all of these things combined with one another, it's much more tricky. So, what we're doing is looking at some of the places where maybe we have some of that style and actually making it modular, and then looking at what can we move into this very flexible compute versus what do we want to keep kind of closer to home. And we're in the process of doing that at the moment. When I think about the way that RenRe approaches this stuff, and actually you'll hear Kevin O'Donnell talk about it at times, we talk about the integrated system. We want a single system, a sort of almost like a sort of functioning organism within the company that is our technology backbone that has all of these capabilities. And what we're finding is that actually moving to a more cloud-based technology, moving to this more modular approach of developing our technologies really helps with that. It's helping to enforce that integration, helping us to enforce that consistency across the organization rather than making it more fragmented. But you need really good linkages between the various parts of your system, and you need a really good data store to base it on. And Tom, you mentioned kind of data federation technologies, or sort of obliquely mentioned those. It's definitely something that we're really interested in. So we're evaluating what can we do with, there are kind of skims you can put over the top of multiple data sets and then access them using kind of an SQL type interface. We're looking at some of that stuff. We're looking at S3 and using kind of S3 buckets in AWS as a way of storing very large data sets and then pulling those back and into important business processes really rapidly. So there's a bunch of technology that's right on the kind of tip of our expectations right now that we think we're going to be turning into some really exciting systems as we go forward.
That's great to hear. It's funny, right? When you look at best of breed modular software and then using APIs and using integration, and what I like to kind of call wrappering that, right? So putting a wrapper around it all, where you have one UI, if you wish, versus that monolithic, what I also call spine transplant, where you rip everything out and put a brand new spine in. It's incredible to watch now how the evolution has changed, right? When you look at the 90s and you look at the early 2000s, it's like, no, rip it all out and put a brand new thing in. And now that is absolutely just not the motivation of today's companies. It's let's find little segments where we can, with agility, plug and play little areas here and there that create immediate impact, that create immediate return on investment, and we'll just wrapper it. We'll wrapper it with a cool looking UI that everyone can see, and it's one UI, but at the back end, there's 400 little systems that are integrating and talking to each other.
I'll go back to some of the stuff I talked about earlier on. When we evaluate these technologies, we're trying to find things that have some generic applicability so that we can cover a broad area. What we find is if we look at point solutions that are really very well tailored to one aspect of what we're doing, that information can end up being siloed and not necessarily becoming part of this integrated whole that we're trying to build. So we're always looking at technologies that have some breadth of applicability, because then it's worth the integration cost to build that into this kind of modular framework. It's worth really doing that correctly, getting it built in and having it feed all the other kind of processes that you want to feed.
Nick, to you on that side of it, when you look at, yes, we're kind of talking here that monolithic versus modular and all of that. What's the strategy for you, Nick? Being as you've kind of touched on it a little bit with the firing up Amazon Web Services or firing up a SaaS model really quick if you need some additional horsepower. Ultimately, what's the approach from your perspective?
Yeah, to be honest, I think Connor kind of nailed it. I mean, we've we've gone with Azure first, and if you think about kind of a first principles perspective of, all right, what's all the data we need to capture, making sure our data model is right, and then designing a system that's flexible enough to capture all this data as efficiently as possible. So again, with some of the cloud stuff you have now, we get bank statements from emails that fires off a trigger to unlock a zip file, process the CSV in there and load it into a database. Or, when we get a file that hits an FTP, that kicks off another trigger to, on the CAP modeling side, take an ELT, do all the manual prep that we would want it to, transform it into how we would load it into our systems. So again, building simple web UIs when it's easier for a web UI to go in and manually adjust the data. And that's kind of how we think about getting data in, or even, having linkages with Excel, because Excel is still, as one of the probably the best business productivity software ever created. It's integrating with Excel, and if underwriter or one of our investment professionals wants to build out a cash flow schedule in Excel and be able to upload it right from Excel into the database, it's having the infrastructure to do that. And then kind of once you have your data models, to those points, you can have all these back-end APIs, and you can there's a lot of really good out of the box tools that you can put right over a database that you already have. So, some of the Power BI tools where, you don't really need a programmer per se to go in and build those reports out. You just have really good analysts that understand the data model, and they can start building their own Power BI reports. And, I think that's generally the approach that we've always wanted to get, so that if you want to, bring in all the transaction documents for a given risk, together with all the modeling, together with all the accounting, you can build that right into your system that you want to look at. And again, those systems don't have to be one giant, integrated legacy system. You can have an API to your accounting, you can have an API to your document storage, and you can have an API to your modeling. And then it's just, building the API, the UI on top of it that brings all that together. But yeah, to what Connor said, it really is a modular approach. It's leveraging, some of these technologies that are, relatively easy to implement kind of out of the box, without needing a massive, team of developers to be able to get, really kind of the key functionality that you want on the data transformation and on bringing the data together.
When you go to market, is your strategy, build versus buy? Is it buy first, then build? Is it build first, then buy? Like, what's your thought process on that? Is it a fluid situation based upon the need within your ecosystem from a solution perspective? How does that work for you on that side of it, Nick? Being that you're more, on the tech side.
Yeah, I think it depends on the solution we're looking for. I think one of the things where, the real buy versus build for us comes down to, is the buy only a 75% solution, and we're still going to have to sink a ton of resources to, take the buy and get it to what we want, and then you're kind of working with limitations of, how some software you bought was built, and really just the cost of getting you kind of from your 80% out of the box solution to the 100%, fully customized solution that you want. So I think that's kind of how we look at it. I mean, there's certain, I think the buy, has massive advantages on stuff that's not our core competencies. Like, so for example, when we look at fund accounting systems, right? We're not, our core competency isn't building a fund accounting system, right? Our core competency is taking risk and managing risk. So, those are the types of solutions we look to buy. I think really when it comes down to the core, what we consider core competencies, we find that it'll be worth the investment to build on our own.
That's a great point, right? I think that's something that I think I miss personally a lot, which is that's your core competence. You believe that you have the core competency to build it out yourself. So it's a really, really insightful point. I appreciate that, Nick. I haven't really thought of it that way before. When you look at the Bermudian market, and I've dealt with it now for over a decade, the relationship-driven process is so quintessential in Bermuda, and meeting with people and having a coffee or going to lunch or going to dinner.